Real estate isn't just about buying buildings, it's about building wealth. Whether you're a seasoned investor, an agent, or just getting started, this podcast is here to help you. We're going to be breaking down things like how to analyze deals like a pro and getting top dollar when you sell your property. Get ready as Rene sits down with experts from the industry, people who've been there, done that, and built real wealth. If you're ready to invest smarter, negotiate better, and level up your real estate game, hit subscribe now. Welcome back to Commercial Connections, Investing with Confidence. Today we're sitting down with our host, Rene Nelson, and she's going to be covering Proformas. Think of a Proforma as an investment roadmap. It helps you calculate a property's current and future earning potential, factoring in rent, vacancy, and operating costs. In this episode, Rene is going to be highlighting how cap rate and price concessions can factor into a deal. Plus, we've got a free Proforma template in the show notes today to help you apply what you've learned. Let's dive in.
Welcome to Commercial Connections, Investing with Confidence. I'm Rene Nelson, CCIM. I'm a certified commercial real estate broker. And joining me today is my podcast editor, Brittny.
Hi, I'm so happy to be here.
I thought what we would talk about today for our listeners is let's talk about Proforma and why that's important. I would love to teach our audience how a Proforma is put together, but more importantly, what is a Proforma and why it's important when you're looking at investing. The reason that a Proforma is so important is it is a financial roadmap that tells you how a property should perform in the market. The difference between a market Proforma and looking forward versus a tax-based Proforma. A tax-based Proforma is looking in the past. What's happened over the last 3 years that the owner has owned this property. A Proforma that I build is forward-looking. It's saying, how's the property performing today? And then how would it perform in 6 months or a year? So I'll give you an example real quick. One thing that gets factored in that I look at is the rent. So if a property is only generating, say, $1,200 a unit, but the market rent is $1,500, then that tells me that I want to build two Proformas. I want to build one for now, what I call actual, and then I'm going to build one for where it could go with the increased market rents.
Yeah, that makes a lot of sense with how quickly things are changing and how fast rents seem to be going up. But keeping up with those prices seems really important for the property owner.
It really is. So when you're building the Proforma, the first thing you want to do is start with the rent. So we've talked in past episodes, I get a rent roll from a property manager and I build that into the Proforma and stick to the end because we're going to share with you a link where you'll actually be able to download a Proforma template that you could look at and use on your own. So in building the Proforma, I take the rents that the property is currently generating. And then, like I said, I look and see what market rent is versus what they're currently receiving. So the first thing that I'm going to do is build one as if the property were selling right now today. And what's the property generating for net operating income? So we start with current rent. And then from there, we deduct out vacancy loss. We've talked about that in past episodes.
Yes.
Of an industry standard is how much?
5%.
Oh, you're listening. That's awesome. Ding, ding, ding. She wins. Well, the problem is if you don't use 5%, then you get schooled by the lender or by savvy investors who are looking at the property because they say, no, your numbers are much too aggressive. We're going to probably have more vacancy than what you. So I just cut to the chase right up front with the seller and say, listen, let's set really realistic expectations for you on your price.
So we look at those factors. Are there any other factors we're putting into the components of this?
So the other thing that you get to factor in is any other income. So if there's parking income, laundry income, pet fee income, then you get to add that in. And that comes up with effective gross income. So that basically is how much income do I have to now cover the property operating expenses, and then what will my net operating income be? Now we go to the operating expenses. There's two fixed costs that you'll always have when you own a property. The first one is property taxes and the second one is insurance. from there, you have utilities, because with apartments, the landlords typically are responsible for the water, sewer, garbage. So you've got utilities, maintenance and repair, property management, and then turnover. And I always try to build in a reserve factor of about 2%. Now, I also want to mention a lot of times people self-manage, but not everybody wants to do that. So when I'm building a pro forma, I search the market to see what the management fee is. Typical rule of thumb is when you get into much bigger units, like 200 units, 300 units, the management fee goes down a little bit, but that's often because they'll have someone that lives on site. And maybe that on-site manager gets a discount in their rent or free rent or a salary stipend. So the management fee goes down often with the bigger units. But let's just say we're looking at 20 to 50 units. 50 units is kind of the break point where it makes sense to 50 units and above is the break point of when it makes sense to have somebody living on site.
Can you think of any other operating expenses that people often forget or maybe lose sight of if they're making their own proformas by themselves?
Absolutely. Turnover is one that they forget. They don't factor that in. And with the maintenance and repair, I typically figure between $500 to $600 per unit, depending on the age and the condition. So if it's a newer property, I just helped some clients buy 2 brand new apartment complexes. Those properties literally were built in the last 12 months. So we know the maintenance and repair is not going to be as deep or as detailed, say, as an apartment from like 1970s.
If you're using a Proforma and you want to use this tool to look at multiple properties as like a stress test, what are some things you're comparing the different properties against?
That's a really good question. So let's say I'm helping a buyer, especially a 1031 buyer. We're going to have other episodes where we're going to dive deeper into a 1031 exchange. But part of the nuance of a 1031 exchange is you only have 45 days to identify the property that you want to buy. And so doing a pro forma and stress testing properties up front is really important. One thing that we do is we'll build a pro forma and basically compare other properties to see what the cash flow is, how much net operating income it generates, and what the cap rate is. And we also factor in debt because most people will use leverage or take a loan to buy a property. And we want to factor in that debt because as the cap rate goes up, so does the risk. So investors always love high cap rates because that means cap rate and price are inverse. As the cap rate goes up, the price goes down. But as the cap rate goes up, so does your risk. I've had clients in the past who have sold apartment complexes and they were 1031 exchanging into triple net property and they were building their retirement portfolio. So they wanted high cap rates. Well, what we found is they wound up selling a 20 unit apartment complex and we went out and we bought stores like an Aspen Dental Clinic, a Sherwin-Williams store, an AT&T store. And for that particular client, he wanted something with a super high cap rate. So he bought in like the 7.5% to 8.5% cap rate range. There was only a short period, like 5 to 7 years left on those leases. So that's why the cap rate was high because it had a short period left on a lease. A lot of times when you're buying a triple net property, you might buy something more in the 5.5% to 6.5% cap rate range, but you'll probably have 10 years left on that lease.
What people are looking for in a cap rate, that could depend on the individual.
It definitely can. With cap rates and looking at the pro forma, I would love to walk you through an example where I just closed a transaction in December and the pro forma stayed the same, but the cap rate changed. This was a 17 unit property near the U of O. So it was within walking distance to the University of Oregon. And we factored in all of the rents. So the gross rents were $249,500. I'm just going to talk in general numbers. I'm going to round stuff to make it easy for the listeners. We took the 5% vacancy factor, so it was roughly $12,500 for the 5% vacancy. And there was a coin-operated washer-dryer system there for the tenants. So that generated about $1,500 in additional income on an annual basis. The effective gross income was $238,500. Then we deducted out the expenses. So we had the property taxes, the insurance, and all the operating expenses that I've talked about, which totaled $93,600. So that operating expense ratio was 39% of the effective gross income. So what that means is the owner was basically spending about 39% of his effective gross income to operate the property for the operating expenses.
And that's a little high?
Oh, you're listening. That's good, because we talked about that in past episodes. 32 to about 40% is where you want it to be. This property happened to be older and not many renovations had happened. So it's still within line. There's no red flags there necessarily, but it is a little bit high. So if I were to buy that property, one thing that I would go in and look at, are there ways that I could start driving down my utility cost as an example? So an example of something that you could do is put low flow water restrictors on the showers. It's a little frustrating to your tenants because it reduces the flow a little bit for the water. But again, when you're paying the water, sewer, and garbage as a landlord, you need every opportunity that you can to try to control those expenses.
Could you do different lighting in the building? Would that help?
We see that high LED lighting is beneficial in large industrial properties, like a 25,000 square foot warehouse that's up for lease right now. And they're going to put in the high LED lighting because it'll make such an impact for the tenant, and it'll reduce the overall utility expense that the landlord is covering. But in residential, we find that not so much, that putting in the LED lighting really doesn't make that big of an impact.
Really changes anything? Okay, that makes sense. And could you restrict because this is the example you were talking about, is like student housing. Could you restrict some of the things that they're allowed to bring on site, like in terms of certain electronics or things that pull a lot of power? Is that allowed?
We really try not to restrict them because there's so many people that are vying for, especially for the students, for their attention. And a lot of those big, I call them institutional towers that are within walking distance to the U of O, that's those 12 and 15 stories. The amenities in those, I want to live there. I mean, swanky. They've got a pool and hot tub and barbecue decks. I helped a student housing group from Chicago put in a 12-story complex within walking distance to the U of O a couple of years ago. And they actually put heated sand volleyball pits up on the roof. And I'm thinking,
oh my God,
who gets that at 18 years old? I don't even have that. I mean, it's crazy.
What a dream. What a dream. I did live in student housing when I first moved to college, and I had to take a loan out to help pay some of my expenses. But I did live in some of those swanky dorm style rooms, and it was worth it though. As a student, you don't want to have to worry about these things. And it's just nice. You're out on your own for the first time, and I really enjoyed it. So I love that it's continuing.
Yes. Yeah. And believe me, they just get bigger and bolder for their amenities package. That one also had a golf simulator in the workout room. So they had all this workout equipment. It looked like a Planet Fitness or an LA Fitness place. And then they had this golf simulator. It was crazy. So let's talk about the cap rate and how that factors into the pro forma. So on this 17 unit property that I had listed, I recommended to the owner, based off of market data driven factors, that we should roll this property out at a 5.3 cap rate. So what that meant, when the net operating income was $144,900, that means the list price was $2,725,000. Now, the beauty of this, as from both a seller's perspective and a buyer's perspective, once the pro forma is created and you go under contract, things can change during the process. Like if a buyer finds things during the due diligence, they may want a price concession, but the pro forma stays the same because we built it going in off of the rent roll and the operating expenses. Those haven't changed in the last 30 to 60 days. What's changing is the price, and that will then change the cap rate. So in this example, I listed it at $2,725,000, which was a 5.3 cap rate. I took it to the open market and we got an offer right away. It happened to be somebody that owns like and similar properties in the neighborhood. And he's ecstatic because he's going to buy it and renovate it. So when he brought the offer to the seller, he offered to the seller $100,000 less than what the list price was. But the seller was super motivated because he was older and his family partners wanted to retire and they just wanted cash flow. They wanted a check in the mail. They didn't want to own student housing anymore. The owner accepted the offer at $100,000 less. And what that did to the cap rate was that made the cap rate 5.52%. The reason that cap rate changed is because the price changed, but the net operating income stayed the same. And I was able to counsel the seller and say, luckily he was already prepared to accept the offer. But often I have to coach and counsel sellers because, we all at the end of the day, we all want to get top dollar. We all want every penny that's available to us, but you also have to listen to reason. My job is to counsel them and to say, listen, this is a pretty good offer. We've got this offer. It's all cash. We're going to go in. He's going to need 30 days to do his inspections, and then we'll be able to close and you can place your money where you want to put it with this other investment. And this seller had an opportunity to 1031 exchange his money into a passive real estate that was going to generate a better cash flow for him than what he was experiencing off of the property. So he was super motivated. He really wanted to do it. So we accepted the offer and we went pending. And then what I did is during the due diligence process, I also accepted backup offers. And the reason that we did that is during the 30-day due diligence process, if anything goes wrong or the buyer changes his mind, they have the right to terminate the transaction and get their earnest money back. We want to make sure that as representing the seller that we have a backup position ready to go. Okay. So we accepted a backup offer. The buyer did his inspections. And then there were some minor issues that were found, like a roof and some different things that we had to negotiate. So the seller wound up giving an additional $25,000 discount in order for the buyer to close. So the final sales price was $2.6 million, and that made the cap rate 5.57%. The interesting part that I want the listeners to understand there is once you've built your pro forma, that's your starting point. And then from there, as things ebb and flow and you're trying to make key decisions, it's all cap rate driven at that point. Does this make sense? Should I ask for a price concession? Sometimes a buyer will ask for too big of a price concession because they want everything fixed. They want a brand new roof and they want everything cured. Yes. And I often counsel my buyers like, that's too aggressive. The seller's probably going to say no. Let's pare that back a little bit so we can come to an agreement and get a yes.
And could you explain like a price concession a little bit?
Okay, so a price concession is where you're under contract to purchase a property and a buyer will typically in writing come back and ask for the seller to give them a discount. And often it's things that are discovered during the due diligence process, maybe a failed roof or bad siding, bad electric, bad plumbing, things like that.
And when you secure backup offers from buyers, do they also have to put down money in escrow?
Oh, good question. They do not. Their offer is accepted and they know that they're in backup position and they'll go into first position if the first buyer terminates, and they do not have to put any earnest money down until the first buyer actually terminates, and then they go into first position.
Are they allowed to start any research on due diligence or Proforma at all on the property if they know they're a backup?
Most of them don't do inspections and start the due diligence process because of time and money. So as an
Okay.
example, on like a 20 unit apartment complex, just the building inspection alone is about $4,000.
Okay.
So most of the time they wait until they go into first position before they start doing that.
Yeah, that makes a lot of sense. And when people are creating their pro forma, is there any advice you would give to look at things like more realistically? Like maybe they find the perfect property, they feel really emotionally connected to it, they really like the location. Maybe they're starting to get like really excited, but would you give them like any advice to stay realistic about some of the numbers and kind of take the emotions out of it a bit?
Yeah, I'm very data driven, and that's probably built into me from my CCIM designation. But I just try to do as much market research and use sold comparable properties, and cap rates are king. The average person is not going to know what a market cap rate should be for that area. You're going to need to seek advice from a commercial real estate broker. You can't
Mhm.
really Google it. It's not going to be accurate if you look it up in Google, and it's not out on Zillow. That's where building a relationship with a commercial broker comes in handy, because
Yeah,
we can tell you what cap rates are and what they should be. And
yeah.
I subscribe to proprietary software where I can get cap rates from across the United States. Moody Analytics is one that I subscribe to, and they've got some pretty phenomenal reports that show you what cap rates are for my hometown, the Pacific Northwest, Oregon, and then it starts going out more geographic from there.
Okay.
And like I said, we can look up cap rates from across the United States, but you really want to talk
That's
to
cool.
an expert in the market.
And in your area, that's super important
Yeah.
as well. So you use Moody Analytics, and that's kind of one of your trusted tools that you use. Is there any tools that you would maybe red flag, or maybe they're kind of misleading about the information? Do you have any warnings there?
Well, that's a really good point, because with cap rates, again, cap rates come off of net operating income. So
Right.
when a property is being advertised, do your due diligence yourself, build your own pro forma. And that's one reason we're going to drop it in the show notes, because you can get a rent roll. Typically, if a property's listed for sale, you can call the broker and say, "Hey, I'm interested, send me the rent roll." And then you can build your own pro forma and fact check the offering memorandum or the marketing package to make sure that the broker's included everything in there for the operating expenses. I've called friends in the industry before and said, "Hey, your net operating income is a little light. You didn't factor in a 5% vacancy factor. You didn't factor in turnover costs." And they're like, "Yeah, you're right. The seller wanted to go as aggressive as we could." So there's no industry black and white that a net operating income must be created this way, or you must factor in these items. The net operating income is however you want to calculate it as a broker.
If someone who was working on their own Proforma and they felt like they weren't getting the right information, or they were like trying to be misled in some way, is there any advice you would give them for like specific questions to ask, or like encourage them to speak up on certain issues?
Yeah, definitely ask for a copy of the seller's tax returns. And you may not get those until you go under contract. So, with the due diligence process, a buyer is going to put up earnest money deposit, but that earnest money is refundable to them during the due diligence process. So, if you really want a property and the seller is not willing to give you the items up front, go ahead and submit an offer and just write in there what you're going to request from the seller for documentation. Go into the due diligence process, and then that's when you can start peeling back the layers of the onion and looking at the tax returns to see what the expenses are. And sometimes you'll see heavy expenses maybe in 1 year on a seller's tax return, a heavy maintenance and repair line item or cleaning and turnover. And you may see that for just 1 year when you're looking at, say, 3 years of the tax returns. But what you're going to ask the seller is, hey, I noticed that your maintenance and repair was quite a bit more. What happened? Because with a CPA, they're going to want the seller to expense that tax or to expense that item in the year, the tax year that it happened. Sewer lines break, different things happen. And so the seller could give you an explanation on that. And then you could just kind of know, okay, that was really a capital expense, but they put it through as an expense, the full expense through for that year.
For that year to get the depreciation.
Yes.
Is there any other like tips or tricks you would give to the audience on creating your own proformas?
I think you really brought up a good point about being excited about a property. My husband used to say, slow your roll and just think it through and look at the rents and ask yourself, are these sustainable or can I increase rents next year? Look at how long the tenants have been in the property because that's going to give you a pretty good idea whether you can raise rents. You know, it's easy to say, oh, this property is 20% below market rent. But if you go in and increase the rents on everybody just because it's that time of the year and rents can be increased, you might experience a 20%, 30% turnover where everybody moves out. And so then you're going to be in a situation where you're probably going to have to go in and put some money into the property to attract new tenants. The rent roll tells you a lot. If a tenant has been there, say 10 years, that probably tells you that it's under rented. And I would recommend that you go in and look at the units as quick as you can when you start your due diligence process, so you know what you're getting into.
This was such a great episode. I learned so much about Proformas. I hope the audience did too. We're really excited to share the free show note guide for you on how to build your own Proforma. Drop a comment in YouTube or Spotify. We can answer any questions you have about Proforma. Connect with a local CCIM agent in your area and let us know if you have any questions. Thanks for listening to the podcast and like and subscribe.
Happy investing.
That's a wrap on this episode of Commercial Connections. We hope that you found value in this episode. Understanding the Proforma is going to be a game changer in making better investment decisions. And we hope this episode helped to break it down a little bit better. On the next episode, we're going to be diving into due diligence and what happens after you accept an offer. We'll break down key financial documents, inspections, and legal next steps to ensure a smooth transition. This is important whether you're buying or selling. You're not going to want to miss this episode. Make sure to subscribe so you stay up to date and check the show notes for our free Proforma template. We look forward to seeing you back here for Commercial Connections.